Hi class and welcome to Chapter 5. This is Merchandising Businesses, Accounting for Merchandising Businesses. Before we get started, I want to quickly give you some breakdown of housekeeping items. We are currently in week 5 of the course. Here shortly, I believe it's after Chapter 8, I want to say, 7, 8. You'll have your midterm exam. The midterm exam will cover chapters 1 through 8. It will be, believe, about 20 questions in length, so it's half a point per question. It's worth 10 points. The 10 points is 10% of your grade, as you know. Each point is basically worth 1% of your grade. That's the way of thinking about it. By now, you should have completed the Chapter 1 quiz, Chapter 2 homework, Chapter 3 quiz, Chapter 4 discussion. Which brings us to Chapter 5. The Chapter 4 discussion, as you know, is a discussion board. It's under discussions in the classroom. That it required you to have one original post in response to the discussion questions and 2 responses to your classmates. When it comes to discussion boards, what I'm looking for, and this is, again, this is in the classroom requirements. So that little link after the syllabus is the classroom requirements or classroom expectations. Within there, there's a link that says discussion boards, and you signed off and you said that you read all this, so I'm hoping that you did. For discussion boards, what is required is by that respective Thursday during the week should be your original response to the discussion questions and 2 responses to your classmates. The responses should be a paragraph in length each. I'm looking for detailed responses, not just oh, you did a good job. Now, that doesn't count. A 1 sentence or 1 quick comment is not a response. I'm looking for engagement. That's the concept behind discussion questions. A paragraph response to the discussion question itself, and a 1 paragraph response each to 2 of your classmates. That's a discussion, okay? Not just oh, you did a good job. No, that doesn't work. Or just a 1 sentence response. That's not a response. It needs to be in detail. So please, if you haven't done that, you need to do that. That's why some of you have asked me, oh, Dr. B, why I didn't get full credit. You didn't get full credit because you didn't make any responses to your classmates. It's in the requirements. It's not only in the classroom requirements area, or what's it called? The classroom, help me here. The classroom expectations, class expectations. But it's also in the rubric for the discussions. So please, for every single discussion going forward, you need to have a full paragraph response to the discussion question by Thursday night. And by Sunday night, you need to have a paragraph each for two of your classmates. So a full paragraph, not just a sentence. I hope I'm being clear on that, because the idea behind it is that we're having a discussion, not just a response, right? So, and a lot you'll find there's a lot of your other classes for this program for your business degree, whatever discipline you're in, whether it's hospitality or one of the other business programs. The idea is that in your other classes, when there's a discussion forum, you need to have a detailed response. It's not just a few sentences. It should be detailed. So if you didn't get full credit, that's why. And what you need to do to fix that is you need to make sure that you have full paragraph responses to 2 of your classmates and a well-detailed initial response to the discussion forum. And that should be the same way going forward. So that's the housekeeping notes. If you have any questions, just please let me know. Okay, so Chapter 5, merchandising business. I want you to think about, when we go through this chapter, think about like Macy's or one of your favorite retailers, okay? Like Amazon, Macy's, whatever the places that kids are going these days. Think of like your favorite retailer, okay? That is a merchandising business. Merchandise is selling physical products. If I sell bottles of water, okay, I sell bottles of water. This is a product. I sell this product. I want you to think about businesses that sell products as we go through this chapter. I want you to think about how much this bottle of water costs me, the business, okay, to sell to you, the customer. And that's what this chapter is all about. So let's talk about that. Okay, the nature of a selling business, merchandising business. This is different than a service business. A service business is like a dentist, a lawyer, an accountant, a doctor. Those are service businesses. They provide services. A lawn mowing business, that's a service. A catering business, that's a service. These are service businesses. They sell you the service, not so much the product. A product is something you can buy from them and take home with you. That's a product. That's a merchandise. The accounting cycle is a little bit different for a merchandising business because there's a different impact on the financial statements. The operating cycle of a business is a process by which the company spends cash, generates revenue, and receives cash for either at the time the revenue is generated or by collecting accounts receivable. In other words, the operating cycle is when I sell you this bottle of water, do you pay me right away? Do you pay me in 30 days? Regardless of if that works, I have expenses, and the process by which I receive the revenue tells me what my operating cycle is. In most businesses that are small and businesses that operate with services, those are usually cash businesses. Then you have accrual businesses that operate on the accrual cycle. That's the accounts receivable. That's the accounts payable. That's accrual, right? That tells me the operating cycle. The operating cycle is different from a merchandising business to a service business. It's dictated by when I receive cash from my customers. So here's what the accounting cycle, the operating cycle looks like. The business purchases merchandise. The merchandise is received by the store. The store sells the merchandise to the customer on accounts receivable or on cash. The store then receives the cash from the customer, and the cycle continues. It goes back. I use that cash from my customer to then purchase more merchandise, to then make more sales, to then collect from more customers, to then purchase more merchandise, to then make more sales. You see the cycle. It's cyclical, right? So this never ends. Unless the business goes out of business, of course. Okay, but the time it takes in days to complete the operating cycle is different from different merchandisers. For example, if I'm a grocery store, I sell you milk, I sell you bread, I sell you other perishable items. I have a very short operating cycle. Okay? Reason why it's short is because my merchandise expires over time. I sell you the product quickly. I then replenish my inventory and then resell it. And I replenish and I resell it. It's a very short cycle. It's very quick. That's the idea behind a grocery store. But if it's like Macy's, it could be a lot longer. The cycle could be a lot longer because jewelry doesn't expire. Clothing doesn't expire. Electronics, they don't expire. The life cycle of the products is a lot longer. So therefore, Macy's has a longer operating cycle. Grocery store like Safeway or Giant or whatever, short operating cycle. But Macy's or a larger retailer, longer operating cycle because of the type of products. Let's look at the differences on the financial statements for a merchandiser. As you know, with a service business, we have fees earned as our revenue minus our operating expenses, such as rent, utilities, wages, you name it, right? Revenue minus our expenses equals operating income. That's service business, right? That's your dentist, that's your lawyer, that's your lawn service, whatever. That's service business. Then you have your merchandising business. Merchandising business, their revenue is considered sales. It's sometimes called merchandise sales, sometimes called just sales. It's the revenue, okay? Their revenue is sales minus cost of goods sold. Cost of goods sold is how much it costs me, the seller, to purchase this bottle of water to then sell to you, the customer. My sales, I sold this bottle of water to you for $1. It cost me, the seller, 20 cents. Therefore, my gross profit on every bottle of water is 80 cents. Of that, my operating expenses to sell this bottle of water to you, in addition to my rent, my utilities, my everything else, my operating expenses, right? My operating income might be like 20 cents, 30 cents, right? So sales minus cost of goods sold. Cost of goods sold is how much this costs me, the seller, to buy and then sell to you, or to make and then sell to you. That's cost of goods sold. So you see the difference. The revenue lines are a little bit different. There's a cost of goods sold for merchandising. There's gross profit minus the expenses equals operating income. Revenue activities for a service business involve the service to the customers, but in a operating business a little bit different. From a merchandising business is a little bit different. The income statement for a service business is fees earned. The expense, you have your operating expenses, and then you have your operating income. So fees earned minus your operating expenses equals operating income. That's for a service business. But in a merchandising business, which is what we're focusing on today, our revenue is called sales. To sell a product to you, I have what's called cost of goods sold. Cost of goods sold is what the expenses to the business to sell the product to you. That's cost of goods sold. To eventually arrive at what we call a gross profit, and that gross profit is what we have before our operating expenses. So again, the basic way to think about it is we have sales minus the cost of goods sold equals gross profit minus operating expenses equals operating income. So there's like an additional 2 steps, basically, is the primary difference. Now, with a merchandise business, we have this thing called inventory. This bottle of water that I sold to you, this is my inventory. I purchased this bottle of water from my distributor, and then I put it on my grocery store shelf to then sell to you, the customer. This bottle of water is my inventory. It becomes my inventory when I purchase it from my distributor and I put it on my shelf to sell to you. That's when it's my inventory. Then when I sell it to you, it becomes cost of goods sold. So inventory is reported as a current asset on the balance sheet. The reason why inventory is a current asset on the balance sheet is because I can quickly convert that inventory to cash when I sell it to you. Okay. Merchandise transactions are recorded in the accounts using the rules of debits and credits. However, the accounting system for merchandising businesses is modified to efficiently record transactions. What do I mean? Well, in merchandising business, we use inventory control systems. This can be either the periodic inventory system or the perpetual inventory system. Periodic means I periodically record my sales of my inventory for the accounting period. Perpetual means I continually update my accounting system to reflect sales as they happen. These two systems impact my ledgers. And as we talked about in earlier chapters, we have a subsidiary ledger. A subsidiary ledger, as you know, is a grouping of individual accounts with common characteristics. A subsidiary ledger would be inventory within the current assets. Inventory is the subsidiary ledger. Current assets is the general ledger. On the income statement, I would have a subsidiary ledger of sales, which is a part of the general ledger for revenue. Think of subsidiary as the child and the general ledger as the parent. Primary ledger, which is also known as the general ledger, is where the balance sheet of the balance sheet and income statement accounts. So again, general ledger is the parent, subsidiary is the child. We also have what's called controlling accounts. These are within the subsidiary ledgers that are represented by the general ledger by summarizing accounts. We'll talk about that later, so not as important. Okay. Here's a couple of examples of subsidiary ledgers. Within accounts receivable, we have accounts receivable subsidiaries. These are called customer ledgers for listings for individual customer accounts. So think of it this way. I have my general account called accounts receivable. Within accounts receivable, I have multiple accounts that represent my customers. I have customer X that purchased X amount. I have customer Y that purchased X amount. I have customer Z that purchased X amount. Those customers collectively make up my accounts receivable. But within accounts receivable, I have multiple accounts. Those are called subsidiaries. The same is said with accounts payable. Within accounts payable, I have my Pepco bill. I have my WSSC water bill. I have my Verizon internet bill. I have my, my other various accounts, right? Collectively, those make up accounts payable. The subsidiaries are WSSC water bill, Pepco electric bill, Verizon internet bill. All of those together make up the accounts payable, but individually they are the subsidiaries that make up accounts payable. And then of course the same can be said with inventory. I sell this bottle of water. This bottle of water is one subsidiary. I might also sell a vitamin water that's a different kind of water. I might also sell soda. I might also sell other beverages. Those beverages together make up a beverage inventory, which are part of inventory. The point is, you could break down the granular levels that are the subsidiaries. And that's the idea behind it. Merchandising transactions. When I sell something, I scan it, okay, at the register. Beep! Okay, I sold you this bottle of water. Every time I scan that, I'm creating a record of that sale. So most merchandising companies use a computer system, the register, they scan it, right? That record similar transactions. We call these specialized journals or special journals. These journals generate purchases, sales, and inventory reports. So at the end of the day, I can run a report that tells me how many bottles of water did I sell. At the end of the day, I could run a report that says how many bottles of water did I purchase from my vendor. And I could also see how many bottles of water I have left in stock. Okay, these are special journals. As I said earlier, there's two types of inventory systems that retailers use. There's the perpetual inventory system and the periodic. The perpetual inventory system records inventory transactions as they occur. So think of like the barcode reader. That's perpetual. It continually updates my records. Perpetual, continually updating my records. So every bottle of water I sell at the grocery store, every time I scan that bottle for the sale, I'm taking it out of inventory. I'm taking it out of inventory every time I scan that bottle of water at the register. It continually updates my records. That's perpetual. Then there's the old school way of doing things called the periodic inventory system. And this comes in handy for like other types of retailers. An example of a company that would use the periodic system is a car dealership. They don't sell a whole heck of a lot every day, but when they do sell it, they update their inventory periodically. Okay. They do a physical count of inventory on the shelf or a physical count of cars in the lot. That's called a periodic inventory system. They update it periodically at the end of the accounting period, typically. Now, how do we record such transactions? In the perpetual inventory system, remember, that's the barcode one. They record every single sale that I make as time goes on. In this example, on January 3rd, I purchased inventory from my vendor. I purchased $2,510 worth of water bottles from my vendor. So I debit my inventory account to increase the amount of water I have available for sale to my customers. I debit inventory to increase inventory, and I credit my cash to decrease the amount of cash I'm paying to my vendor. I purchased inventory of water from Bowen Company. Now, if I were to purchase that water on account, it's recorded a little bit differently. I debit inventory to increase my inventory amount, and I credit accounts payable. This is to show that I purchased my bottles of water from my vendor, Thomas Corporation, but I'm not going to pay Thomas Corporation just yet. So I'm going to credit accounts payable to show that I'm going to eventually pay them. I'm increasing accounts payable by the amount of the inventory. Now, when I purchase inventory, I typically purchase them on terms. And these terms of the inventory are typically shown on the invoice or the bill that the seller sends to me, the buyer. Now, for example, if I were to purchase 1,000 water bottles from my vendor, Thomas would send me an invoice or a bill that says, hey, you purchased 1,000 water bottles from me on this date. I shipped them to you on this date, and here's what you owe me. All of those things would show up on the invoice. And here's when you owe me. And here are the terms. You need to pay me within 30 days. If you pay me within 10 days of that 30 days, I'll give you a 2% discount. All of those types of things would be outlined on the bill. Now, here's an example of what that bill looks like. Here's an example of an invoice. You have an invoice number. You have who it's from. Sold to is going to be you, the customer. Customer order number, the date of which you ordered it, the day of when you received it, or when it was shipped, how it was shipped, from and to, the terms, and the invoice date. You see here, and it'll also show the quantity, what it was that you bought, how much each unit price was, the total amount. Okay, let's break it down. So, when it was shipped, great. Here's the important thing. The terms. This says 210 net 30. 210 net 30. This means that if we pay this bill within 10 days of receiving the bill, we'll receive a 2% discount. Otherwise, the balance of the bill is due within 30 days. That's how this reads. 2% discount if you pay it within 10 days. Otherwise, the entire amount is due within 30 days. That's how it reads. 210 net 30. And this could be different. This could be totally different, this first part. It could be 210 net 15. Or 250, this could be 215, which means 2% within 15 days. It could be 510, it could be 515, whatever. It doesn't matter. There's no standard here. But what you need to know is how to read it. 2% discount if received in 10 days. Otherwise, the net needs to be received within 30 days. Those are the terms. The invoice date, this is when the bill was sent to me. Okay? Where it was from. I received it was shipped from San Jose and arrived to me in Cincinnati. FOB. FOB means free on board. And we'll talk more about that here in a little bit. Free on board. Quantity, they shipped me 20 printers. At $150 a piece, that's $3,000 total. $3,000, how I got that, unit price times quantity equals amount. And that's an invoice. Terms of when payment for the merchandise are made are called credit terms. Credit terms, that's what this is. 210.30, that's credit terms. If payment is required on delivery, it'll say COD, cash on delivery, or it'll say cash or net cash. Otherwise, it's specified an amount of time, also known as the credit period, which is typically 30 days. It'll say N30, net 30. That's the credit period of what you need to pay it within. So an example would be you receive your electric bill from Pepco and it's due within 15 days. It'll say N15 on the bill, net 15. That 15 days is the credit period. Credit period usually begins with the date of the sale shown on the invoice, typically. To encourage buyers to pay their bill early, we oftentimes provide them with a discount. In our example that I showed you, the 210 part, that's a 2% discount if the buyer pays within 10 days of the invoice date. If they decide not to take that discount, the remaining amount is due within 30 days. That's why it reads 210 net 30. That's a purchase discount. Yeah. So here's what it looks like. The 210 net 30 part. So we received our bill on January 5th. If I pay within that first 10 days, I'll receive a 2% discount. That means I need to pay it by the 15th of that month. If I pay it within that by the 15th, instead of paying the total amount for $3,000, I could pay $2,940. How I got that amount? $3,000 times 2%, 3,000 minus that 2% discount gets us to $2,940. Otherwise, it's due by February 4th, and the full amount is due by February 4th. Any questions so far? Does this make a good amount of sense?
Yeah, it makes sense.
Great. Thanks, Josh.
Yeah.
Okay. Great. Thanks, John. Okay. Thanks, Kendra. More about purchase discounts. Discounts taken by the buyer to encourage early payment is called a purchase discount. Purchase discounts are taken by a buyer to reduce the total cost of the merchandise purchased. The idea is that when you're running a business, you don't want to pay a whole heck of a lot. You know, the idea is to conserve expenses, conserve cash when you're running a business, because nobody wants to blow all their cash on purchasing inventory. You know, you want to try to get discounts. So in order to get those discounts, you might want to pay early, right? You pay early, you pay less. That's the idea. That's the idea behind purchase discounts. That's why having terms like 210.30, they're helpful. So like when you have your own business, you want to have a continuous cash inflow. You want cash coming into your business as much as possible, as frequently as possible. In order for that to happen, you want to offer your customers a small discount, like 2%, in order to encourage them to pay early. That idea helps them to pay their bill on time or pay it early. And it helps you, the business, to make a steady cash flow. So going back to our example, in order to pay an invoice on January 15th, which is the last day of the discount period, in this example, the company decided to borrow $2,940 to get that discount. That's an okay idea as long as you could pay it and still save money. If the company borrowed the $2,940 and it had an annual interest rate of 6% within 360 days, the interest rate on that loan for the remaining 20 days would have been $9.80. Do you think, looking at this slide, can anyone tell me, is this a good deal? Do you think the company should have borrowed $2,940 in order to receive that $60 discount? What do you think? If you're the business, would you have done this? Would you have borrowed $2,940 to get that discount? What do you think, Josh?
So it says the interest remaining in 20 days of the credit period is $980. So you'd be paying $980 in 20 days to receive $60 back.
Exactly.
It makes sense because at the end of the day you're still saving what, $50.20, right?
That's correct. Yep, you're absolutely right. And I agree with you. I would do that I would do that deal all day long in order to save that additional $50.
Yeah, because especially like $50 or 20 cents, whatever it is, a month might not sound like a lot, but over the course of a year, that's probably money that's going straight into the investors' pockets.
100% correct. Or just think of it this way, Josh. Let's say this is one order of like 100 within that month. The savings behind it is astronomical. So yeah.
Yeah, exactly. Yeah.
I agree with you. Yep. So the answer is yes. This is a good deal. This is what I would do as well. Thank you. So yeah, just as Josh and I were discussing, a 2% discount on $3,000 is $60. The interest for that 20-day loan, 6% on $2,940 is $9.80. So if you think of the savings, $60 minus that interest rate, $50.20, it's totally worth it. Yeah, absolutely. So fun little calculation. And so what is it in a percentage? So how much did I save percentage-wise? So if we did not take the discount, if I didn't pay that within that 15 days, instead of the interest rate just being that 6%, it would have been 36%. Now, how do you figure, right? It's if the savings is 2% times 360 days, which are banking days within a year, divided by 20 days, which is the discount period, gets us to 2% times 18, gets us to 36% interest for that 360 days. So all this tells us is that we are better off taking that discount, paying it within that 15 days than we would be if we were to take out that loan and it lasts for an entire year. So, interesting case. And that happens a lot in business, and you'll see that throughout your careers. Since buyers normally take purchase discounts, inventory is debited in the amount that's purchased under the perpetual inventory system. It's because the buyer debits inventory for the amount of the invoice that's discounted. So what does that look like? So remember, the example was a full $3,000 worth of inventory that we purchased to sell to our customers. The inventory that we purchased was $3,000 worth. We decided to take the discount by paying our vendor within 15 days. So because we made that decision up front, I record the amount that reflects the discount. So instead of recording the $3,000, I record $2,940 for inventory, and I record $2,940 for accounts payable. And then that 10 days later, I pay my vendor by debiting accounts payable and crediting cash for that same amount. So again, it's two different transactions. The first transaction is to reflect the purchase of the inventory with the discounted amount. And the second transaction is to reflect us paying our vendor. So first, I'm purchasing it on account. The second, I'm paying the vendor. Which, as you know, that's the concept of accrual-based accounting. Okay, now let's talk about purchase returns and allowances. A buyer might request an allowance for the purchase of merchandise that is returned, also known as a purchase return, or a price allowance for damaged or defective merchandise. Here's an example. Let's say I purchased 1,000 cases of water from my vendor, okay, Poland Springs. I purchased a bunch of cases of water from Poland Springs, 1,000 cases. Out of that 1,000 cases of water I purchased from Poland Springs, 5 cases were damaged during shipping. So when I opened them up, the waters are all cracked and they're drained, and it's just a mess, right? Maybe a pallet broke on the truck, or a pallet fell off the truck, whatever. Things happen, right? So it was damaged. I have two choices. I can either send the damaged cases back to Poland Springs for a refund, also known as a purchase return, or I can say, hey, listen, Poland Springs, you sent me some damaged stuff. I want a discount. We call that a purchase allowance. Okay. From the buyer's perspective, such returns and allowances are called purchase returns and allowances. That's the name of the account, purchase returns and allowances. In both cases, the buyer normally sends the seller a debit memorandum, also known as a debit memo, to notify the seller for the reasons of the return. In other words, I will send Poland Springs a memo that says I'm returning these damaged products, and I expect to be refunded for the amount of those products. Or I could say, hey, listen, you sent me 1,000 units. Out of those 1,000 units, 20 of them were damaged. I want a purchase allowance, or also known as a price reduction for those damaged products. We call that a purchase allowance. Go ahead. Do you have a question?
Yes. So I know where I work, we get credit memos, and so would it be into the same category?
Yeah,
If I was to get,
it's the
yeah, so
exact opposite. Yep, that's right. So a credit memo is what you would issue to your customer.
okay.
A debit memo
Okay.
is
So
what
if
I'm
if I'm the business purchasing for example the Poland Springs, and say we got damaged goods and they issued me a credit memo for the future,
correct.
would that be entered the same way into the purchase returns and allowances, or would that be set up into a different account?
Yeah, no, it would be set up the same way. The difference between a credit memo and a debit memo, the debit memo is something that I, the buyer, enter into my system. You, the seller, you being Poland Springs, you would enter it as a credit memo.
Okay, so that's why the documentation that I received says credit memo at the top, is because that's their copy, essentially.
You got it.
And then I, as the consumer, should be putting that into my account as a debit memo.
You got it.
Oh, okay, that makes
That's
more
correct.
sense.
Yep. And the reason why we do that, Josh, is because of the accounts payable system. As you know,
Yeah.
when I debit accounts payable, I'm reducing accounts payable.
Yes.
That's why for me, the customer, it's a debit memo. I'm reducing the accounts payable by that amount.
Okay, that makes sense. Thank you.
Yep, my pleasure. Yep, absolutely. Very cool. And here's an example of a debit memo. Here's what it looks like. You get the company's name of the distributor at the top, the customer's name, date of the purchase, the number of units, what it was, price per unit, and the total amount. That's just an example of what it might look like. Some companies it looks a little bit different, but this is just an example of a debit memo. Okay, the buyer may use the debit memo to as a basis for recording the return or allowance, or they might wait for approval from the seller. In either case, the buyer debits accounts payable and credits inventory. So we're reducing our accounts payable and we're reducing our inventory by that damaged amount. Here's an example of what that entry looks like. So on March 7th, I realized, hey, you know, I have some damaged inventory. I reduced my accounts payable by that amount, and I reduced my inventory by that amount. That reflects me taking out the damaged amount and then sending it back or destroying it, whatever the case is. Before paying an invoice, a buyer may return inventory or be granted a price allowance, an invoice with a purchase discount. In this case, the amount is returned record at the invoice amount less the discount. Example, if I purchased 1,000 units from Poland Springs, 20 of them were damaged, instead of me sending back that 20 units, I might say, hey, Poland Springs, just give me a discount on my purchases for those 20 units, and I won't send them back. I'll just throw them out or whatever. In that case, we call it a discount. So we need to record that discount. In this example, we purchased $5,000 worth of inventory, 210 net 30, which 210 net 30, we ended up purchasing 4,900. So 5,000 minus the 2% discount equals 4,900. I debit inventory 4,900 and I credit accounts payable 4,900. Debit inventory to increase inventory, credit accounts payable to increase accounts payable. Then I said, hey, listen, $1,000 worth of this stuff is damaged. I need to send back or destroy $1,000 worth of defective inventory. So I take off the $1,000 worth. But here's the thing. You already recognized a 2% discount when you initially paid it within that 10 days. So because you recognize that discount, you also need to discount the amount that you're returning. Because otherwise it wouldn't be fair, right? It'd be like saying, oh, I'm returning $1,000 worth. No. You're not returning $1,000 worth. You're returning $980 worth. Because you already recognized that 2% discount when you initially purchased and paid for it, remember? So that's why you want to make sure it's consistent. So if I purchase inventory and I pay them within the 10 days, I reflect that amount in my initial inventory purchase. If I need to return any of that inventory to my vendor, I also reflect that same discounted amount, right? Because you need to make sure that it's consistent, in other words. You need to reflect that same discounted amount. So in that return entry, I need to decrease accounts payable by 980 and decrease inventory by 980. Why 980? $1,000 worth of damaged inventory minus the 2%. It's the discounted amount. So ultimately, when I go to pay my vendor, so I received the inventory, some of it was damaged, so I sent it back 2 days later, but I'm still going to pay my vendor within 10 days to make sure I get the discount. I debit accounts payable, $3,920, and I credit my cash to decrease my cash, $3,920. Why $3,920? The initial purchase amount minus what you sent back. That's how you get to $3,920. Questions, or does it make sense?
No, that makes sense.
Great, thank you. I'm drinking my inventory. Gotta drink some water. Okay, let's talk about sales. One of my favorite things, sales. Got to sell, right? Revenue from merchandise sales are typically recorded as sales or sales of merchandise or merchandise sales, whatever the business calls it. In most businesses, it's just sales or it might be merchandise sales. Those are the typical names. But as you know, with merchandise businesses, we call our revenue sales because we're selling merchandise. Here's an example. Let's say I sold $1,800 worth of merchandise. And I sold it directly to my customers. They came in, they bought it, they walked away from it with it. They bought it in cash. So I debit cash and I credit sales. I debit cash $1,800 to increase my cash on hand. And I credit sales $1,800 to increase my sales revenue. Using the perpetual inventory system, the cost of goods sold, and the decrease of inventory are recorded. How do I do that? So as I sold that $1,800 worth of sales, I have to reflect the sale of that inventory. The inventory cost me a total of $1,200 when I purchased it from my vendor. So I need to debit my cost of goods sold by $1,200 to increase my cost of goods sold. And I need to decrease my inventory by crediting inventory $1,200. And you want to do this at the same time that you record the sale. So you see, March 3rd, I sold $1,800 worth of water. That water cost me, the business, $1,200. So I debit cost of goods sold $1,200, decrease my inventory by $1,200. Now, as you might expect, the difference between the $1,800 and the $1,200, that's gross profit. So $1,800 minus $1,200 is your gross profit. That's what? So what's that? $500? $600. Sorry. Now, as you know, when a customer comes in to buy something, they might either give you cash, they might use their credit card, they might use their debit card. It doesn't matter. Regardless of how a customer pays for something, it's cash. It could be a MasterCard, it could be a Visa, it could be American Express, it could be whatever the freaking, nobody cares. It's cash. Why is it cash? It's because that money comes directly to you right away through the process of the clearinghouse. When you swipe your credit card to buy the bottle of water from me, I get that cash right away. The minute you swipe that, it goes into my bank account, right? Therefore, I recognize that credit card sale as cash. It gets recorded as cash. It doesn't get recorded as credit because it doesn't take 30 days for me to receive it. I receive it right away. So therefore, it's cash. So a credit card transaction is the same as a cash transaction. That's what you need to know with business. Credit card is the same as cash. The difference here is that you, the vendor, you have to pay a fee to the credit card company for that transaction. Now, here's where it gets kind of ridiculous in business. Okay. When I sell you this bottle of water for $1, you pay that dollar with your Visa or MasterCard or your debit card. I, the vendor, the seller, I have to pay a fee to the credit card company. Okay? It's like 2% or 3% of the transaction. So for every dollar water bottle that I sell to you and you pay using your credit card, I have to pay 2 cents or 3 cents when you swipe that card. Okay? That's one of the costs of doing business. That's why most businesses, they prefer you to use cash because there's no fee involved with cash. But when you use your credit card to buy $1 worth of stuff, they don't like that because they have to pay 2 or 3 cents when you swipe that credit card. You don't pay that, the business does. And so every time that happens, we expense that out. So when I sell you this bottle of water for $1, my cost of goods sold is 50 cents, but then I need to pay another 2 cents to the credit card company. And that 2 cents, I classify that as credit card expense on my income statement. Does it make sense? And yes, it sucks for most businesses. That's why they don't like doing it.
But that's also why a lot of small businesses have minimums on credit card purchases.
That's right. That's right. That's exactly right. But either way, they still have to pay the percentages.
Yeah.
So even then, it really doesn't make too much sense. But yeah, you're right.
Do some credit card processing companies or do some of them have a flat rate for under a certain amount?
Not that I'm aware of.
No.
No, not that I'm aware of. From what I understand, and
that's the only way it would make sense.
Yeah, exactly. And there might be in some cases.
Maybe gas stations, because I see that there more than anything.
Maybe gas stations, yeah, that could be true. But from what I noticed, Josh, is that for a Visa and MasterCard, it's either 2 or 3%.
Yeah, that's what it is. It's I think it's 1.85 for
it might
Visa
be
MasterCard for us. And then it's like 3% for American Express.
That's right. Yeah, because back in the day when I had my own business, it used to be like 2 or 3% for Visa and MasterCard, and then it was like 5% for American Express.
Oh, really?
Yeah, but over the years they've come down in their.
I know that's also why a lot of businesses don't like to accept certain credit cards.
They don't like to accept American Express for that reason.
Exactly.
Yeah, good point. Yeah, it's an interesting business expense. So,
Excuse me.
yes, please keep on.
What type of business you at?
I had a wholesale, retail, and distribution company of organic food products. I would sell a line of seasonings that I got from a manufacturer. I would sample it to various grocery stores and get them to purchase it and carry it on their store shelves. And I was basically a distributor. I was a middleman. I would buy the inventory, which was the food products, from the manufacturers, and then turn around and sell that to grocery stores. And I took that from a $0 to $3.2 million business within a matter of 6 years. And it was successful. It was a very successful business. And I also accepted credit cards, and I had to do the same thing. I had to pay credit card expenses. That was a normal part of doing business. So in this example, the company had to pay processing fees of $4,150. So what is the transaction we need to do? At the end of that respective month, because of the rules of the principles of accounting, we would debit credit card expense, which, as you know, is an expense on the income statement, to increase that expense, and we would credit our cash to then pay the credit card processing company. So, fun stuff. Okay, here's another example. The company sold merchandise on account for $18,000. Cost of goods sold was $10,800. We debit accounts receivable because we sold it on account for $18,000. We credit our sales to increase our sales, $18,000. To represent what we sold, we debit our cost of goods sold to increase cost of goods sold by $10,800. And we credit our inventory by $10,800. That's to represent a sale on account. All right, let's talk a little bit more about customer discounts. A seller might grant a customer a discount called a customer discount. What this does is it incentivizes your customer to, pay in advance, right? An example, the seller may offer customer discounts to encourage customers to purchase in large volumes or pay early. Sometimes you might go to a store and they'll have what you call a buy one, get one free sale. Or buy one, get 50% off on the next one. Or buy two, get one free. Or, you've seen this. You've gone to a store and have seen that type of sale, I'm sure. Everyone has. The reason why they run those types of sales is to encourage you to buy in volume because they need to move the inventory out of their store. The idea is to get you to buy more or to get you to pay early. A sales discount encourages customers to pay their invoice early by offering them credit terms such as 2% discount if you pay within 10 days. Otherwise, you pay the entire balance in 30 days. The idea is to incentivize customers to pay them early because you're offering them a small discount. The real purpose behind doing this, again, is to generate cash flow for the business that is steady. So let's assume the company sold $18,000 worth of merchandise to a company with 210 net 30. We record the sale as 17,640 because there's a 2% discount. So 18,000 minus 2% is 17,640. Debit accounts receivable for that customer. We credit our sales to increase our sales by the same amount. Our customer later pays us 9 days later. We receive cash from our customer, 17,640, and we credit our accounts receivable to reduce our accounts receivable, 17,640. Everyone's good so far? Makes sense, right? Okay. Good. Great, thank you, Joe. Okay. Refunds. Oh, I never like giving refunds, but unfortunately it happens from time to time. Cash refund. When a buyer receives merchandise that is defective, damaged during shipment, they don't like it, they don't want it, whatever. Unfortunately, you might have to give them a refund. That's called a cash refund. Or you can grant them an allowance, a customer allowance. What that does is it reduces the accounts receivable owed on the original selling price. So let's say I am selling you 2 bottles of water for $2, right? And you come back to me and say, Dr. B, I don't want this one bottle. I'm sorry, I didn't want it. I don't know why I bought it. I didn't use it. I want a cash refund. I'll give you $1 back. Or you might, or let's say you bought 2 bottles of water from me on account, so you owe me $2. Then you come back to me a few days later and say, Dr. B, I really didn't want the second bottle. I'm going to give it back to you. And you'll say, hey, just give me $1 off of what I owe you. That's called a customer allowance. That's how that concept works. Let's look at it from an example. This customer issues a refund of $900 for merchandise that was damaged during shipment. The company agreed to keep the merchandise and to make any necessary repairs. Okay, great. So what do? Our company then we debit customer refunds payable $900 and we credit cash $900. The customer refunds payable account, we increase that to represent the amount that we would then pay to our customer for the damaged goods. And we credit cash to represent the payment of cash to our customer for those damaged goods. What about our customer refund payable? Is a liability account that is estimated refunds and allowances that will be paid or granted to customers in the future. It's recorded at the end of the accounting period as part of the adjusting process. When you use this account called customer refunds payable, typically we estimate a certain percentage of what we think might be either refunded or discounted. And typically that's just like an estimate. It's like, oh, on average I break 2% of my inventory when I ship it. Okay, so that might be the amount that you would put into that account to begin with. In some cases, a customer who is due a refund has an outstanding credit, so we would issue them a credit to that account. And Josh, this is what you and I were talking about earlier with the credit memo. So instead of paying a cash refund to a customer, we would grant them an allowance of what they already owed us. We call that a credit memo. It indicates the intent to the customer against their accounts receivable. So going back to an example, let's assume that our customer, instead of a cash refund, they wanted us to reduce the amount that they originally owed us by $900. So what our company would do is we would issue a credit memo to our customer on whatever date that was to reflect the allowance against their account of $900. On our journal entry that we need to make is we would debit our customer refunds payable account by $900, and we would credit that customer's receivable account by $900 to issue the credit to their account. What about returns? Let's assume that we have our customer wants to return $3,000 worth of stuff that they bought from us for a cash refund. The merchandise that originally cost us, the company, $2,100. That's how much it cost us to buy it from our vendor. So we need to make two entries to reflect this return. We debit customer refunds payable $3,000, and we credit cash $3,000 to pay our customer back for the refund. Since they're sending the inventory back to us, we need to put that inventory back into our inventory. So we would debit our inventory account $2,100, and we would credit estimated inventory returns $2,100. This reflects that the customer gave us back the inventory. It wasn't damaged, nothing wrong with it. They just didn't want it or whatever. We're just putting it back in our inventory. That's what that second entry shows us. The estimated returns inventory account that we just saw here in the second transaction is a current asset account that's reported on the balance sheet after inventory. It represents an estimate of merchandise that will be returned by its customers. The record at the end of the accounting period is an adjusting entry. So basically, when we use this customer refunds payable account and or this estimated returns inventory, we're estimating a certain percentage every year that may come back to the company. That's kind of how that works. Let's talk about freight. Freight is what we use to deliver the merchandise to our customers. And it's what's used to deliver it to us to get ready for sale. Here's an example. I sell bottles of water, of Poland Springs. I call up Poland Springs, or I get on their website and I order 1,000 cases of water to sell to my customers. So I enter my purchase order to Poland Springs. Poland Springs then puts it on a Poland Springs truck or some type of distributor, and they send it to me to get ready to sell to you. That's freight. The truck itself, that's freight. Yeah? The movement of goods from one person to another, that is called freight, purchase or sale. The terms of the sale indicates the ownership and title of the merchandise as it passes through from the seller to the buyer. The point determines whether the seller to the buyer who pays the freight cost. Okay, so in other words, when I put my purchase order into Poland Springs to buy the water, I say, hey, Poland Springs, I want to order 1,000 cases of water. What they typically do is they'll say, okay, great. They'll sell me the 1,000 cases of water, but it'll cost me something to get it to me. We call that freight, the cost of freight. When it gets onto that truck and it starts its journey to me, I'm responsible for it. So if the truck derails, truck blows up, something happens to the truck, I'm responsible for it because I paid for it. But if Poland Springs says, hey, listen, 1,000 cases of water, don't worry about shipping, that's on us, they're responsible for the shipment. So let's look how does that work. The ownership of the merchandise passes from Poland Springs, passes to me, the buyer, when Poland Springs delivers the merchandise to me through the distributor or through their truck. In this case, we call it free on board, or FOB, shipping point. When you see the word shipping point, that means that the seller is responsible for it until it reaches me, the buyer. We call that shipping point. I am the shipping point. I'm the final destination. The term means that when the buyer pays for the freight from the shipping point to the final destination. That's why they call it shipping point. These costs are part of the buyer's total cost of purchasing the inventory and are added to the cost of inventory by debiting the inventory account. So how does that look? On January 10th, our company purchased merchandise from our supplier for $900, FOB, free on board. The freight that we paid was $50 to get it to me on the 10th of June. So 10th of June, I make two transactions. I debit my inventory of $900 and I credit my accounts payable to pay my vendor later on, $900. I also then record the cost of freight. I paid the freight, right? I paid the freight. So I debit inventory $50 and I credit cash $50. You can see that my total cost of inventory is $950 based off of these two transactions. The $900 was the initial cost of the inventory. The $50 was the freight to get the inventory to you to get it ready for sale. Or to me to get it ready for sale. Okay, now let's look at some more ownership stuff. Ownership may pass merchandise to the buyer when the buyer receives the merchandise. We call this FOB destination. When you see FOB destination, that means the seller is responsible until it reaches the buyer, in which case the seller debits delivery expense or freight out. Okay, how does that look? Let's assume that our company, sells merchandise to our customers. We sold merchandise to our customer on account for $700. Term FOB destination. This means the cost of the goods sold is $480. Our company will pay the freight to get it to our customer, $40. Now, oftentimes, when you purchase something from like, let's say you go on to Target and you notice that it's free shipping. Nothing is free, okay? Nothing is free in life. It's free to you. It's not free to Target. Target has to pay for the shipping. Okay, so when my customer buys the cases of water from me, and I say, hey, shipping is free for you, I have to pay for the shipping. Somebody's got to pay the shipping. Shipping is never free. Somebody's paying for it, whether it's the seller or the buyer. Okay, so how does that look? I debit accounts receivable, I credit my sales, increase my sales, increase my accounts receivable. This represents the sale of the merchandise. When I sold that merchandise, the merchandise cost me something. It cost me $480 when I bought it from my distributor. So cost of goods sold, debit, cost of goods sold, increase cost of goods sold, and debit or credit inventory to reduce inventory, $480. Then, of course, I shipped it to my customer and said it's FOB Destination, which means I'm paying for the shipping. So I debit delivery expense, which is on your income statement, and I credit my cash to pay for the delivery. Are we good so far? Does it make sense?
Yeah, it makes sense.
Great, thank you. Okay. The seller may prepay freight. So sometimes I might prepay my freight through FedEx or UPS or the Postal Service, whatever. We call that FOB shipping point. The seller will then add the freight to the invoice. The buyer, in this case, the buyer debits inventory for the total amount in the invoice, including the freight. Any discounts would not apply to a prepaid freight. And then here's what that example looks like. I debit. Here's some strange noise. I can't figure out what that is. Okay, I debit my accounts receivable to increase accounts receivable. I credit cash to increase sales to represent the sale of that inventory of $800. That inventory cost me, cost of goods sold, $360 when I bought it from my vendor. So I debit cost of goods sold to increase cost of goods sold, and I credit my inventory to reduce my inventory. And then the third transaction is accounts receivable, $45. I prepaid my shipping. So when I prepay shipping, as you know, prepayment is an asset. So I would reduce, again, that customer's prepaid account $45 and credit cash to pay for that shipping. And here's just a nice little illustration of what it looks like. FOB, shipping point, title, freight, buyer, FOB destination, seller, freight, title, buyer. It's basically a representation of who is in possession of the freight as it's being transported. Okay, and here's a nice visual representation of those transactions that we looked at. The debits and credits for inventory. Remember, these are your T accounts, right? Inventory, estimated returns, cost of goods sold. Each merchandise transaction affects a buyer and a seller. Okay, I mean, that's obvious, right? Let's look at sales tax. As you know, anytime that you sell something, you're supposed to collect taxes for that sale of that product and remit those taxes to the respective agencies. Typically, you have a state sales tax. Sometimes you might have a local sales tax. Like if you're in the city of New York, you have state of New York sales tax and you have city of New York sales tax. But typically, every state has a sales tax, typically. Not all states do, but most states do. They have a sales tax on the sale of merchandise. The liability of that sales tax is incurred when the sale is made. So, when you purchase this bottle of water from me for $1, I charge you, the customer, $1.07. The dollar is for the merchandise. The 7 cents is the sales tax. So I collect that 7 cents from you, the customer, and then at the end of that month, I send that 7 cents to the District of Columbia to represent the sales tax that I collected from you and gave it to the state, or to the district in this case. So at the time the cash sale is made, I collect the sales tax from you, the customer, and then eventually I'll send it off to the district. So when a sale is made on account, the seller charges the sales tax to the buyer by debiting the accounts receivable. The seller then credits the sales account for the amount payable to the sales tax, and we credit that to sales tax payable. As you know, sales tax payable is a liability account. So what does that look like? If I sold you something, I sold you $100 worth of stuff on account, and there's a 6% sales tax in the District of Columbia, I would charge $106 to your account. Debit accounts receivable $106. I credit my sales $100, and I also credit sales tax payable $6. You see that $6, that sales tax, the actual sale of the inventory is $100. So 100 plus 106 equals 100 plus 6 is 106. Eventually, I'll have to pay that sales tax to the state. So when I do that, I debit my sales tax payable to reduce my sales tax payable account, and I credit cash to represent me paying the sales tax to the state. Then there's also this thing, this is kind of rare. We call this trade discounts. This is another discount thing. Wholesalers are companies that sell merchandise to businesses rather than to the public. Wholesalers publish or upload sales catalogs online. Wholesalers then offer special discounts to governments or businesses to purchase large quantities. These are also called trade discounts. An example, if you are a member of Costco or Sam's Club or BJ's Wholesale or one of those big box wholesalers, you are classified as an individual or a business, and you buy in bulk. When you buy in bulk, you get a discount. It's called a trade discount. And oftentimes, the sellers and buyers do not normally record list prices, but they do record the discounts. For example, you purchased $1,000 worth of stuff in a 40% trade discount. We would then say $600 is the trade amount. So again, it's kind of rare, but it's just kind of show you that that does happen. Then, of course, as you know, financial statements are impacted for merchandise businesses through the balance sheet for the record of inventory and on the income statement for the record of cost of goods sold. Now, when it comes to preparing the income statement, it can be either performed as a multi-step or single-step format. A multi-step format basically shows the individual steps, also known as subtotals. We have sales minus cost of goods sold equals gross profit minus our expenses to get to income from operations plus or minus other revenue and expenses equals net income. This is called a multi-step format because, as you can see, there are subtotals involved. Sales minus cost of goods sold equals gross profit, minus operating expenses equals net income from operations, plus or minus other revenue and expenses equals net profit. So as you can see, multiple steps. That's why we call it a multi-step. And of course, there's also single step, which is just sales minus expenses equals net. That's a single step. With respect to cost of goods sold, as you know, it's sales minus cost of goods sold equals gross profit. Cost of goods sold is the cost of which it costs me, the seller, to sell to you, the customer. The excess of sales over cost of goods sold is called gross profit. Again, sales minus cost of goods sold equals gross profit minus expenses equals net income. Income from operations is called operating income. We have different types of expenses in business. We have selling expenses and administrative expenses. Selling expenses include things like sales salaries, supplies used to sell to customers, depreciation of store equipment, delivery expense, and advertising. All of these types of expenses are called selling expenses, and we can attribute these directly to the merchandise. We also have what's called administrative expenses, which are also sometimes called general expenses. These are your overhead expenses for the business. These would include things like office salaries, depreciation of office equipment, and office supplies used. In business, we have other revenue and other expenses. When you see other, it means that it's not used in the day-to-day operations of the business. Other means other. Other revenue would include things like rent, income, income from interest, a gain from the sale of a fixed asset. Those types of activities are not a part of the day-to-day operation of the business, but they sometimes happen. We call that other revenue. We also have other expenses, which also cannot be directly tied to the day-to-day operation of the business. This would include things like interest expense or the loss from the sale of a fixed asset. Let me see, what else can I tell you? This is an example of what that looks like. We have sales minus cost of goods sold equals gross profit. Then we have selling and administrative expenses broken out by category. You add all those up to get your total operating expenses. Add all these up to get your total administrative expenses. Your gross profit minus your total expenses equals your income from operations minus other revenue and expenses equals your net income. That's what a multi-step looks like. Single step is the opposite. It's where everything's kind of condensed down into a single step format. So it's basically like saying sales equals total sales plus other revenue equals total revenue minus your various expenses like cost of goods sold, selling, administrative, interest, other expenses. So total revenue minus total expenses equals net income. That's the way it would look in a single step format. And from a merchandising perspective, we have retained earnings plus net income minus any dividends that you paid out to your stockholders equals the change in retained earnings. Retained earnings beginning of the year minus any changes, plus or minus any changes equals your retained earnings at the end of that year. And of course, the balance sheet you can see is categorized based off of liquidity, current assets, cash, accounts receivable, inventory, estimated returns for inventory, office supplies, prepaid insurance. Those equals total current assets. Then you have your long-term assets, which is also known as property, plant, and equipment. To get total the long-term, current plus long-term equals total assets. Then you have your current liabilities, your long-term liabilities to get your total liabilities. Then you have your stockholders' equity. And as you know, the accounting equation is total assets equals total liabilities plus equity. Okay. And just to recap a little bit more, adjusting entries for customers, returns, and allowance. These are adjusting entries that are made at the end of the accounting period. And to make those entries, we're also adjusting or estimating for percentages for estimated refunds, estimated returns, that type of stuff. And again, those are estimates. And it's usually based off of an industry average or an average based off of the company's history. That's kind of how that looks. I'm just going to kind of go through this a little bit quicker because it's not as important. Inventory shrinkage, inventory shortage. This is it. Inventory shrinkage means some of your inventory was stolen or was never accounted for. Inventory shortage means you weren't sent the right amount that you had ordered. Yep. And of course, we need to account for stuff like that. And then, as you know, just as the accounting cycle dictates, you need to make closing entries at the end of the accounting cycle. That also includes things like cost of goods sold that get closed out to your temporary accounts and make its way through the closing process, through the closing entries. Cost of goods sold, as you can see, is there. And it makes its way through the process and eventually onto the balance sheet. Okay, and just to close out the chapter, I want to tell you a very important ratio. It's called the asset turnover ratio. This measures how effective the business is in generating sales using its inventory. A higher ratio indicates an effective use of its inventory. To calculate the inventory ratio, we take our total sales, which is total revenue, divided by the average total assets. Average total assets is calculated by taking your total assets from year to year, okay? Beginning of the year minus the end of the year, beginning of the year minus the end of the year, divided by 2 to get your average. That gives you your average total assets. And that is the end of the chapter. Are there any comments, questions, or concerns I can help to answer for you at this time in regard to Chapter 5 or anything else in the class?
The only question I have is what time are we meeting tomorrow?
Oh, you and I?
Yeah.
1:30.
Okay, perfect. That's it.
Absolutely. My pleasure.
All right. Thank you.
Thank you. Are there any other comments, questions, or concerns from the class I can help to answer for you at this time?
I have a question. I've been trying, since I have my book, I've been trying to catch up on assignments.
Sure.
I don't know where to find the Cengage homework assignments because every time I click on it, it sends me to somewhere weird.
Yep, don't go there. Okay, so Joan, here's what you need to do. Click on course content in the classroom. Click on the respective module, so we're in module 1. And then you'll access the Cengage homework directly through there. So for example, week 2 is where the first homework assignment is through Cengage. So course content, week 2, learning activities, and then click on Chapter 2 homework. And that will open up. It'll bring you to, when it loads, it'll bring you to the homework assignment.
Okay.
Okay?
All right. Thank you.
My pleasure. Let me know if you have any trouble. Just send me an email, okay?
Okay.
Great. Okay, anyone else? Keandre, Kayvon, Lakeisha, are you all okay before we call it a night?
I guess I'm okay. Can you hear me?
I can hear you. Yay, wonderful.
Okay, I'm guess I'm okay. It's a lot of information to process after work.
It is. I totally understand. The good news is this is recorded, so if you need to go back and watch and pause and all of that good jazz, you can.
I'm definitely gonna have to.
I got you. No worries. And again,
All right.
Lakeisha, if you need anything, you just let me know, okay?
Okay, then I will. Thank
All right.
you.
Sounds good. Have a good night. Keandre, Kayvon, are you both okay?
Yeah, I'm okay, but I have a question.
Yeah, what's up?
So there's a lot of work and stuff. So of course, I'm not gonna actually remember everything and process everything you said. So I was wondering, is there any practice tests or any thing I could practice on?
No, but I tell you what, the good news is that for quizzes, you can take those up to 2 times. For homework assignments, it's unlimited.
All right. So for the
But there are practice. So yeah. So if you go into your homework, okay, and it looks like this, right?
yes.
There's this button up here that says Study Tools.
Yeah.
If you click on study tools, there's this button right here. It says adaptive study plans.
Mm-hmm.
If you get into that, it'll open up. You can start studying for each respective chapter. It'll run you through the exercises.
All right.
So that's probably another good area for you to take a look at. That and of course, if you review the PowerPoints, review the videos, and if you go through those exercises, I promise you'll do fine.
All right. And also, when our midterm?
The midterm is going to be at the end of. Here, let's take a look. The midterm is going to be at the end of Module 2. Which is going to be after we do Chapter 8. So we just did Chapter 5, so we got 3 more weeks. 3 more weeks.
Oh, so around like October, at the end of October,
End
basically.
of October, you got it. Uh-huh.
All right, thank you. That's what I want to know.
My pleasure. Yeah, absolutely.
Oh, here's another thing.
Yeah, what's up?
So how was you able to find? So I'm trying to start my own little clothing line. I'm trying to start my own clothing line.
Okay,
That's
tell me about it. Tell me about it.
That's why I took interest when you said that you was you had your own business.
Yep, that's right.
So how was you able? Because you said you was the middleman, right?
That's
So
right. Yeah.
how did you find your connects?
Yeah, so I did a lot of searches, right? So like if you hop on to you said you're in clothing, right?
Yes.
So if you look for clothing wholesalers, for example, it'll come up with a lot of stuff, a lot of junk. There's a couple of like decent wholesale websites you can find depending on the type of fashion that you're looking for. For example, like this one, wholesale7.net, they'll have like a lot of various types of apparel. Like right now, they're selling costumes for Halloween, but like you can get into like different designers, different styles, you name it, right? And so you can connect with wholesale websites. Another way to do it is just to really do some cold calling. Pick up the phone or send an email to some of the wholesalers that you find on the web and start pricing stuff out. You can get an idea of what they're selling. Like you could buy t-shirts for like 50 cents or $1 or whatever.
Yeah, I realized that because what you got? I found this other website, but it's not t-shirts for 50. I found it for what? About like a good $2.50.
Couple dollars, yeah. Yeah, so
Yeah.
yeah, so just go like different websites like that and start pricing stuff out. You can also get reviews. There's also like magazines and review websites. So like wholesale reviewers or reviews. There's a couple of like different sites that do reviews on different types of wholesalers, and you could get an idea of like who's reputable, who's not, that type of stuff. You want to make sure that whoever you connect with, especially in clothing, it's super sensitive, right? Because there's a lot of the wholesalers are in China. Their sizes run differently, so you got to be super careful of like the different wholesalers that you're connecting with, because when you get that inventory from China, some of it might be like strange sizes, right? And so like you want to try to get them to send you samples before you go placing bulk orders. So just kind of like call them, contact them. There's a lot of different ways to get into the networks. So I mean, the best advice I could give you is just to kind of like do some searching online, and then also to try to get into like groups. So like if you get onto like even Facebook or LinkedIn or the other social media platforms, try to connect with other wholesalers and get an idea of who the distributors are. So this just kind of give you an idea of how to get a hold of these people.
All right, thank you.
Hey, my
I
pleasure.
appreciate it.
Yeah, anytime you need help, you just let me know, man. I'm here to help you.
All right.
All right.
Have a blessed night.
All right, you too. Take care, buddy. Kendra, are you good? Okay, I'm going to take that as you're good. If you ever need anything, you let me know. I'm around, okay? And you have a good night.